Okay, hi everyone. Welcome to today's webinar. So for today's session, we are going to be starting off the year by talking about a brief introduction to Forex. Okay, I shouldn't say brief. This is a pretty in-depth intro. So it's basically everything that you need to know before trading Forex. We'll give about 2 more minutes to let more people join the session before we get started. So in the meantime, let me know in the chat if you guys can see me, hear me, and of course see my slides. And yeah, we'll start in about 2 more minutes. Thanks, everyone. Okay, let's go ahead and get started. I think you guys should be able to see my screen now. Yeah. Okay, so as per usual, a disclaimer and risk warning before we get started. The information is not considered as investment advice or an investment recommendation, but instead a marketing communication. Risk warning, our products are traded on the margin and carry a high level of risk, and it is possible to lose all your capital. These products may not be suitable for everyone, and you should ensure that you understand the risk involved. I'm Melanie, and I'll be your speaker for today. I'm an investment analyst at Rocket, who were finalists for Best FX and Equity Research in the years 2019 to 2021. Okay, so we have quite a bit to get through today. This is just a brief agenda. We're gonna start off by mainly talking about some fundamentals, some things to look out for, and then we'll get on to our technical analysis, where we'll go through a couple of techniques that you can use for your trading, if we have time. Okay, so starting off, what exactly is the FX News Calendar? On the left here, we have investing.com, and on the right, we have Forex Factory, although there are a lot on the market that are mostly free to use. Forex Factory is the one that we typically like to use. So what exactly it is it allows traders to see at one glance all important economic data releases, and it shows us key events such as GDP, CPI, NFP, crude oil inventories, and even central banks' monetary policy meetings. So understanding some high impact events, firstly, we have the FOMC meetings. So this list is mostly US based events. We have the FOMC meetings, Federal Open Market Committee, and it's the US Fed's way of communicating their view on monetary policies. Next, we have the Fed interest rate decision, which normally comes together with these meetings. And if the Fed is dovish, the USD is bearish. If Fed is hawkish, USD is bullish. If interest rate goes up, the USD is bullish, and if interest rate goes down, the USD is bearish. Next we have employment data. So NFP is your non-farm payroll and it measures the change in citizens that are employed from the previous month, excluding farming industry. Next is the unemployment rate, which measures the total unemployment of workforce that is seeking active employment from the previous month. Crude oil inventories, these measure the weekly change in the amount of crude held by US firms. If crude inventories increase, we can expect oil prices to drop. EIA is our energy info admin and it's a short-term outlook. Monthly forecasts for the year ahead, the demand and prices across major fuel types. Okay, so next, some benefits of using an FX calendar. Depending on the individual's trading style, but it does help you plan your trades and allocations for the day, week, or month ahead. And it helps to alert you of upcoming important news that might affect volatility. Okay, so some data links that we use here, or we use quite often are just on the screen. Forex Factory, like I mentioned earlier, some government news, current releases, ISM World, as well as BizGov, and of course the Federal Reserve. Okay, so going through a couple of fundamentals to understand our fundamental analysis. Starting off with the major central banks, we have the Federal Reserve. Um, we also have the European Central Bank or ECB, Bank of Japan, Swiss National Bank, Bank of England, Bank of Canada, RBA, and RBNZ. Next is the DXY, US dollar index, so just some information on it. So the DXY components and average weights DXY was established in 1973 after the Bretton Woods Agreement was dissolved. The base was set at 100 in 1973, and all current values are relative to this base. Weighted average of the US dollar relative to the following currencies: Euro is 57.6, Japanese yen 13.6%, pound sterling 11.9, Canadian dollar 9.1, Swedish krona 4.2, and Swiss franc 3.6%. So just one example of looking at economic data here, because I don't want to spend too long on the fundamentals. This is just an example of comparing US inflation to which is our CPI data versus ISM prices average. So this is just one example, and I think we got this from, let me just check. Pretty sure it was from Trading Economics. So another website that we normally like to use as well is tradingeconomics.com. Yeah, that's normally where we go to find these charts. Yeah, so at one glance, you can pretty much see, yep, all of the GDP, all the information that you need on the major countries. You can also search up some on your own if you're interested over here. But it also includes news. It also has its own calendar, but we normally don't use this one. Let me give you a brief intro to Forex Factory, which is the economic calendar that we normally use. Okay, so this is what the Forex Factory page looks like. So for trading economics, we mainly look at the charts. We don't really use the calendar here, but again, it's entirely up to you. So you can look at countries or recent news releases as well, um, based off of this list. And then for economic calendars, which is For example, the ones that I went through earlier, investing.com is one, Forex Factory is the one we normally use. You can look at the dates. Let's maybe look at this week. And we have it filtered to only focus on the medium and the high impact events represented by the orange and red icons. So you can also look at the lower impact, which are the yellow icon or non-economic events. That mainly includes like your bank holidays. Event types, you can also feel free to remove any you're not interested in. We normally just prefer to have it all ticked. Any currencies that you're not interested in, you can remove as well. Okay, so these are all of the events for the upcoming week, and you can see it's a lot more, um, there are a lot more events to cover. So that's why we just focus on the medium to high impact events, because those will have the greatest effect on your charts. Okay, so yep, these are all the events, and you can see it'll give you the actual value once it's released, but before that, it'll give you the forecasted value and the previous as well. Okay, now let's get back to my slides. Okay, now we're gonna jump into looking at the technical side of things. So in order to manage a trade, we've already gone through the fundamentals or very basic understanding of the fundamentals. Next, we're going to look at what exactly a trade consists of. So I'll introduce the basics of trading. We'll go through the entry, the stop loss, and the take profit. And then we'll go through break even, partial profit very briefly, and idea validation very briefly in this webinar as well. But if you were here for our previous webinars last year, yeah, we went through all of these mostly more in depth in future webinars as well. Okay, so let's talk about why trade management is important first. Firstly, is that it helps you to control risk. So trade management strategies such as your stop loss orders, and position sizing helps traders to limit your losses and manage overall risk exposure. Secondly, it helps you to maximize profits. So trade management strategies like take profit orders and trading stop losses, these help traders to lock in profits and maximize your returns. It also helps you to manage your emotions. So if you've started trading, you would know that trading is quite often an emotional task. So the discipline and the structure that trade management provides can help traders to stay calm and rational, even in volatile markets, which can often prevent impulsive decisions that's driven by fear or greed. Number four, improving trade efficiency. So by having a well-defined trade management plan, you can make faster and more informed trading decisions and avoid the cost and time of having to constantly, monitor and adjust your positions. Okay, lastly is increased consistency. So effective trade management and also having, a trading journal if you don't have one. Um, you can consider getting one because it helps you to achieve consistent results over time by reducing the impact of individual losses, helps you to record what went wrong, and overall helps you to maximize the impact of your winning trades. Especially if you're new to trading, yeah, you can consider getting a trading journal. Okay, so let's take a look at an example. The red area here shows a strong resistance area. Okay, so resistance area is basically when there are a couple of swing highs or even one swing high in line with that area. It's already considered a resistance area, but it's considered stronger if there are multiple swing highs in line with that area. So here we have two swing highs, and our trading strategy, for example, maybe it requires us to have a fixed take profit of 100 pips. So we place the target beyond this strong resistance area, and let's see how this plays out. So price shot up and missed our profit target by a few pips before reversing back down. Reason being, price tends to reverse off of really big areas of resistance and support. So in an alternative scenario, if we had placed our take profit before the key resistance level, we would have gotten a profitable trade. So it's important to look at the charts and adjust your take profit and stop loss accordingly. So here's the proper stop loss and take profit placement. We typically recommend you to place your stop loss beyond and your take profit before. So here's the reason behind it. Here we're talking about Fib confluence, which is basically Fibonacci confluence, which is another indicator, which we'll go through more in depth in future webinars. But so the reason why we place our stop loss beyond is because more often than not, price is attracted to such strong areas of confluence. And if your stop loss is right before instead of beyond it, you'll most likely get stopped out before the market reverses. So that's also one of the reasons why most people wonder why they got stopped out right when the market starts to reverse, and then they complain about stop hunting. Um, Another thing to note is to place your take profit before. Reason is because when price reaches your Fibonacci confluence area, there's a high chance that it won't be able to go beyond it. And instead of reaching your profit target, it reverses back to your entry or worse, your stop loss. So again, that's one of the reasons why people complain that the market's being manipulated because they miss their take profit by 1 pip. Okay, so here's another example to show you why you shouldn't have a fixed stop loss. Here we have a support level with two swing lows in line with one another. So price has bounced off the support level, and we're expecting it to continue to rise to the swing high resistance. So our stop loss of 100 pips is fixed at the 1894.75 level at the support. So instead, price goes down, touches the stop loss, and bounces perfectly from the support. So what we should have done instead was to place our stop loss slightly beyond the key level of support and resistance so that we're not stopped out at the support, because price, as we mentioned earlier, tends to be attracted to these key levels of support and bounces off them. So if we're not going to have a fixed stop loss or take profit, the better alternative is to use a dynamic stop loss placement. So a dynamic stop loss is a trading strategy which is used to manage risk, in which the stop loss level is adjusted dynamically based on market conditions. So the level of the stop loss is continually moved to a more favorable position as the price of an asset moves in the desired direction. The goal of a dynamic stop loss is to lock in profits while minimizing potential losses. The placement of the stop loss can be determined by various technical analysis indicators or other market conditions such as volatility or market trend. So let's go through one example. Here we have two Fibonacci levels that are in line with your stop loss. Not to worry if you're unfamiliar with Fibonacci. I'll show you a website at the end of the session where you can just go through it on your own. We also have, I think we have a few Fibonacci webinars lined up for the year, so stay tuned for that. But for now, just take it as a confluence area that I went through earlier, which is basically when a couple of Fibonacci levels line up with a swing high or a swing low. So that level is our stop loss, and it's in line with a swing high, so it's a resistance level. Price is currently testing the 87.819 level at our entry, and we're expecting it to drop. So here's a simple example to demonstrate dynamic stop loss. Price has bounced off nicely off the support level at 86.721. So 87. 86.721, yeah. And we expect it to reverse off the entry at 87.819. And that's in line with the 100% Fibonacci projection level. So instead of putting our stop loss exactly at the Fibonacci confluence area, like in our previous slide, we want to move it to beyond the confluence area instead, and we'll show you why in the next slide. So if we had put our stop loss right at the Fibonacci confluence area, we would have been stopped out. So price is often attracted to such strong areas of support and resistance before reversing off these areas. Okay, so ultimately you can see price reversed perfectly off the confluence area and hit it towards our take profit. So now let's look at another example. Here we expect price to bounce off our entry at 87.625 at the pullback resistance in line with the 78.6% Fibonacci retracement. Okay, so price has hit our entry and has reversed nicely off of it and is currently heading towards our take profit. Okay, so the take profit is in line with the 78.6% Fibonacci retracement. And price just touched our take profit before reversing off of it. Okay, so it's a good thing that we placed it there because price reversed off of it and rose straight to our stop loss. Okay, now our last example for this dynamic take profit placement. In this example, we have two Fibonacci levels lining up with our take profit. So I've highlighted the confluence area there. And we're expecting prices to rise from our entry to our take profit. So the take profit placed above our confluence area, price reversed off of it and missed our take profit by a few pips. Take profit placed below our confluence area, price hits our take profit nicely before reversing back down to our entry. Okay, so another method, or before we get into another method, do you guys have any questions so far about the dynamic take profit placement? I think it's pretty straightforward for now. Okay, let's move on. So next, we're going to talk about break even. So this refers to the point at which a trade reaches a level where the trader has neither made a profit nor suffered a loss. So it's the point where the cost of your trade, including fees and commissions, is equal to the price at which the trade was executed. So for example, if a trader buys stock at $100 and sells it at 110, the trader has made a profit of 10. But if the trader buys a stock at 100 and sells it at 90, he obviously has made a loss of $10. Um, but if the stock is sold at 100, then he's neither made a profit nor suffered a loss. So that's the break-even point. So in trading, it helps traders to determine the minimum price that they need to sell their trades in order to cover the costs and avoid a loss. So that's important information because it can be useful in deciding when to close a trade and take your profits or cut losses. So here's our break-even level in this example. So it's, as we mentioned earlier, it's a level where you are in profit and you recognize that there's a risk of reversal. So here we have an entry at the breakout of a multiple swing high resistance level, and we're hoping for price to push to the take profit. So take note of our original stop loss at 0.2. um, over here, the original stop loss, and that's in line with a swing low support. Now at point 3, price reaches our break-even level. Over here, it reaches our break-even level and it breaks out of it, or rather it reverses off of it. So hence we move our stop loss to our entry position here to kind of protect our position. So if price continues to our position, then that's good. But if it reverses back to our entry, we want to be protected. So here we can see price has broken above the break even, but it quickly reversed and it hit our stop loss. Okay, so this is just a very brief introduction to this break even technique, um, which is also related to what we've been talking about, having a dynamic stop loss and take profit. Any questions so far? Okay, next let's look at another trading method, which is our partial profit. So partial profit in trading refers to the practice of closing only a portion of a trade when it reaches a certain profit target, while leaving the remaining position open in order to potentially capture further gains. So the idea behind partial profits is to lock in some of the gains while giving the remaining position room to potentially continue to move in the desired direction. So for example, if a trader buys 100 shares of a stock at 100 and the stock rises to 110, the trader might choose to sell only 50 shares, taking a partial profit of $500. The trader would then still have 50 shares that are now worth 550 and could potentially continue to make profits if the stock price continues to rise. So partial profits can help you to manage risk by allowing you to take some profits off the table while leaving room for further gains. It can also help to improve the average price of a trade if the trader decides to add to the position later at a lower price. So it basically is typically used when there is a strong resistance area and you're unsure if price will rise to your take profit. So here's our example. Here we're looking at a 38.2% Fibonacci retracement and another Fibonacci level, and that both lines up with our partial profit level. So this is where we've identified our partial profit to be at. So we expect price to rise to our take profit, but there is a strong resistance at this area here, the Fibonacci confluence area. So that's why we placed our partial profit in that area. So you can see here, price reacted off the strong resistance area at our partial profit and it reversed off of it instead of heading to our take profit. Um, Going back to our break-even placement, this is just a kind of a real-life example to show you guys how it works. So here, our take profit is in line with a swing high, 100% Fibonacci projection lines up with our entry, and the stop loss is in line with the swing low. Here you can see a couple more Fibonacci levels lining up with this random, seemingly random level in the middle here, and we've labeled that as our break even. So you can see this is important because it's in line with another two swing lows. So we're expecting price to reverse off our entry and continue upwards, right? But it might not hit our take profit. So we've identified this level as our break even, and it hit our break even nicely. Okay, so once it hits our break even, then we quickly move our stop loss to our entry to minimize losses. And luckily we did that, so we got out at break even. Okay, any questions on partial profit or break even? Okay, if not, we'll move on to our last slide. I'm going to start off with this slide first. So we're going to talk about idea invalidation pretty briefly. So it refers to the process of evaluating a potential trade idea and determining if it should be disregarded or acted upon. So essentially, it's a way of determining if a trade idea still holds up in light of new information on market conditions that can be determined by your technical indicators or other factors. So here's how it works in trading typically. So there's your initial trade idea about your potential trade. So based on the analysis of your market conditions or technical indicators, then you make your trade idea. And then followed by evaluation of the idea. So you then evaluate the idea by looking at the current market conditions and other relevant information like your fundamental analysis. So that will include um, economic data or like central bank announcements, things like that. So that helps you to determine if your initial trade idea still holds. Next is your invalidation criteria. So you'll identify or you'll establish your criteria for invalidating the trade idea, such as specific price levels or market conditions that would cause you to reconsider the trade. And then next is monitoring. So the trader continues to monitor the market and the security in question to see if the invalidation criteria are met. If the invalidation criteria are met, the trader may choose to exit the trade or adjust their position. On the other hand, if the criteria are not met, the trader may continue to hold the position or add to it. So in short, it basically helps you to make more informed trading decisions um, and avoid potential losses. So let's look at this example here. So this case, we've identified our idea and validation to be in line with this swing high, which is in between the take profit and your stop loss level. So here we're going in for a sell entry and we're hoping for price to drop down all the way to our profit target all the way down here. But instead, prices rose, went upwards towards our idea and validation level, and it's been triggered here. Then we move our take profit up to the entry. And yeah, and then we got out of the trade at break even before price rose further and would get us stopped out. I think this is pretty straightforward as well, pretty similar to the examples that we've been looking at. Okay. Any questions? Okay, great. If there are no questions, we still have a bit of time. So I'm going to briefly go through some Fibonacci techniques with you guys. Okay, so this is the forexarmy.com and this is completely free to use. So you can see there are a bunch of trading guides up here. How to draw a Fibonacci retracement correctly, MT4, support and resistance guides as well, some trading tools. So feel free to just check out this website. It's just theforexarmy.com. Um, we have some videos as well, if it'll load. Okay, we share some videos here. It's not really loading on my page now, but we have videos on retracements, which is the most used and very simple to use as well. And we also have extensions. And yeah, so I'll just briefly go through some of the basics of Fibonacci since we still have some time. So something that's super important to take note of when you're first looking for a chart to use, you need to make sure that you're looking for a clear market structure. So something like this instead of something like that. Okay, so um the Fibonacci levels can be used in both choppy and um clear markets. But another way to fix that is to actually change your time frame. So here I'm changing my market structure from the M15 to the H1. And you can see that's a much clearer frame. Okay. Um, so general rule of thumb is that your trend line should follow price structure closely. Trend line can deviate from price structure, but not by too much. So we have some examples here as well. You can see in the GIFs, you shouldn't cut through the price structure like this. It should follow the price structure really nicely. And we have a few examples below. So for starting off with retracements, the levels we use are over here. Um, these are the key Fibonacci retracement levels that work normally. How to draw it? Firstly, is to look, is the market structure clear? How to identify the recent trend, are prices going down or up? Identify major swing lows and recent major swing highs. Connect the two extreme points, highest to lowest in a downtrend and lowest to highest in an uptrend. Yeah, another point to note is that your ending points should never have bars to the right that breaks below it. So here's a correct example of drawing your Fibonacci retracement. An incorrect example, oh yeah, this is also a correct example, but an incorrect or invalid example is over here. So the quality is a bit bad, but bear with me. So the starting point is in line with a swing high, ending point with the swing low, but we can't use it anymore because price has already broken below this ending point. So the minute price breaks below it, we can't use this ending point as our retracement. So instead, this point here should be our ending point. Okay, so now let's look at Fibonacci retracement levels that are below 100 or below zero. So the levels, this is what we call Fibonacci expansions, and they use levels minus 27 and minus 61. So this is what it looked like. It all uses the same tool, the Fibonacci retracement tool, just the negative levels here. We also use levels that are greater than 100, and those are called the extensions. And I'll go through them maybe in another webinar. Okay, another projection actually is over here. Oh, this is how to use the expansion. So the expansion here, you can see the minus 27.2. We're expecting price to come down to where it'll bounce off of over here. Okay, and this is ultimately what happened. So it bounced off really nicely from this minus 27.2 expansion. And the pro tip is that price usually comes back to your ending point. Okay, so for these Fibonacci expansions, you want to look out for a flash zigzag shape. So something like this over here, this yellow arrows. Or if you look at this GIF here, the clearer the movement of the flash shape, the better. Ideally, you want to wait for prices to retrace at least 50% in zero point 0.3 before taking off in the other direction. Um, yeah, so that's why we talked about Fibonacci confluence earlier as well, which is basically where two or more Fibonacci levels line up with each other. Yeah, and it shows you how to identify these confluence areas as well. But of course, the basic is to firstly know how to identify the individual Fibonacci levels. So we go through a couple of examples here, um, starting with a retracement, and then we have a bunch of smaller retracements, and expansions that line up. So feel free to check out this website on your own. I'm just briefly covering it. And next, we also have trade management with Fibonacci confluence, which I already talked about at the start of this webinar. Yeah, so it goes through more examples on how to improve your support and resistance levels by combining them with Fibonacci confluence areas. And also you can use these levels or these indicators to help you with your trading. And we'll cover all of these more in depth throughout all of our webinars for the year. So stay tuned for those. And if you have any requests for any specific topics that you'd like to go through, you'd like us to go through, feel free to pop them in the chat or just let us know. Yeah, that's all I have for you guys for today. Stay back for a while in case you guys have any questions. But yeah, that's all from me. Okay, we have a question. What's the name of this website? Yeah, it's just the forexarmy.com. I'll just plop it into the chat. Any other questions? No? Okay. Um, if not, that's all I have for you guys for today. Thank you guys so much for joining me. I hope you guys found the session helpful. And have a great rest of your week. I'll see you guys again next week. Thanks, everyone. Bye.